Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today with Robert Sinn, also known as Goldfinger on CEO.ca and CeoTechnican on X/Twitter. He's the publisher of Goldfinger Capital on YouTube and Substack, so definitely check out the links we put below this interview so you can follow along with all the work Robert does in the sector. And Robert is prolific as far as writing, as far as doing videos, doing technical analysis. So it's always great to have you on the show, man, just to get your take on things. And so we were talking before the call, there's actually so much going on all at the same time when you look at gold and silver, copper, uranium, when you look at what's happening from some of the larger voices in the macroeconomic sphere all the way down into fundamental drivers. There's almost too much to cover in any interview, but let's dive into it head first here. I guess let's start with the precious metals. They continue to do well. We saw some big moves in gold and silver. What's your takeaway as far as these metals continuing to move at very high levels of prices?
Hey, Shad, it's always a pleasure to speak with you. It's great to be on the KE Report. Yeah, I mean, I think we had gold, was it up 8-9 days in a row? It felt like quite a win streak that ended yesterday. I guess between October 9th and October 23rd, gold was up about $150 an ounce from 26.20 to 27.70. We gave about a third of that back on Wednesday, but we're getting a little bit of a bounce here today up to 27.40. You know, what I make of it is it's a running bull market. So I don't think we have to overthink it too much and get too into technical levels and price indicators and technical indicators. Sentiment is bullish, but it's not euphoric. Every sentiment gauge I look at, we have not hit the warning sign levels that I would be concerned at. And just, anecdotally, I don't think anybody holds gold still, even at 2,700. Yeah, there's some Costco buying going on, but we were both at a conference in Fort Lauderdale a few days ago, and there's some high level people there, some really good CEOs, some pretty famous investors. And the gold panel, I think 2 out of 3 seats were empty in the room. So here we are at a beautiful hotel in a beautiful location with the beach out front. And we're talking about one of the biggest bull markets in the world today. And 2/3 of the room is empty. That's not a top to me, buddy. So even though gold got smacked on Wednesday, I think it's just natural. It can't go up every day. It can't go up every day. So it's good it got smacked. In fact, I wouldn't be too worried if we broke back down to 26.75 or even 26.50. Of course, the gold bugs don't want to see it ever go down, and it's a conspiracy if it does. But look, this is a bull market. Let's not overthink it. Silver hit above 35 an ounce on Tuesday. It also got smacked on Wednesday, but really the breakout level is 32.75 or 33 area. So we're still above that. So look, I'm loving silver. I'm bullish silver. I'm bullish gold. But of course, I've been bullish from much, much, much lower levels. I think our first conversation was probably when gold was 1,400 or 1,500. But yeah, I mean, that's my take, is the sentiment is still not there yet. There's still more upside here. And it is a real pleasure to hear Paul Tudor Jones get on CNBC and say, yes, I'm long gold. I'm bullish on precious metals. I'm bullish on base metals. And we're going to have to get out of this debt bubble through inflation. It's really financial repression is sort of the only way out of this mess that many countries have gotten themselves in, including the U.S.
Yeah, I think it's important when voices like Paul Tudor Jones are backing the commodity sector and backing precious metals and explaining to the general market the thesis behind it, which many people listening, it's preaching to the choir. But I think when you start seeing that adoption in the general marketplace and a little bit more focus on it, although surprisingly not that much focus considering the breakouts we're seeing in the precious metal sector, just diving into how silver relates to mining stocks. When you look at silver, the move it made earlier this week, yes, it's gotten smacked back down, but everybody's been watching for that move above 32.50. It finally got it, 33, 34, up to 35, came back down. That's kind of normal market action. But that's the speculative side of the precious metal sector. And a lot of times, if you overlay a 10-year chart of silver and the GDX, they almost are mirror match. So it kind of shows the animal spirits coming back to the mining stocks too. How do you feel about the reaction you've seen? I guess we'll do it in two chunks: the majors and mid tiers that are in these ETFs versus the juniors that a lot of people hold that are listening to this call.
Well, it's interesting because we had at the end of last week, Thursday and Friday, I feel like we had the whiskey bottle starting to pour into the shot glass in the mining sector, including in the junior mining sector. And Friday saw some really big moves that extended into Monday, a little bit into Tuesday, but now we're seeing some profit taking and some downside here. So even with gold still bid at 27.42, we're seeing some red in the junior mining sector, which is interesting. Why is that happening? I don't know, but it still feels like this is early in the move, but it clearly appears that some people who may have bought at higher prices and been holding on for a while have an opportunity to get out, and they may be taking that opportunity here, this week. Or perhaps it's a sign that people are concerned that gold and silver have just run too far too fast. But I still think that we're early in this move. So even though, look, there's going to be day-to-day volatility, there's going to be down weeks, it's not going to go straight up. I think you stick with the miners here, you stick with the juniors. I mean, I guess part of it could also be that the biggest gold miner in the world, which is Newmont, is getting absolutely hammered after reporting Q3 earnings. And they clearly have just a cost inflation problem that they haven't been able to get costs down. So perhaps that is bleeding into the juniors, just from a sentiment standpoint. I'm actually kind of surprised at the extent of the downside here. And, Newmont down 13% now today. I mean, I would have thought, down 6 or 7%, sure. They missed on the bottom line. Their costs in Q3 went above $1,600 an ounce, which obviously is not the right way. They were supposed to go down back under 1,500 and they went up. Of course, they're guiding to 1475 cost per ounce in Q4, but they did the same thing last quarter. So I think they have lost the market's confidence again. After a good few months run there here in 2024, Newmont is back in the penalty box, which is where they were at the beginning of the year. So it's not a place that they're, unaccustomed to being in, but definitely a penalty box move for NEM here today, down 13% on earnings. That could be bleeding into the juniors.
Well, and the other factor, this is interesting you bring this up because people have kind of tunnel vision and a myopic view of the mining space through Newmont, Barrick, and Agnico because they're the three heaviest weighted majors inside of the ETFs, and Newmont's the largest gold producer on the planet now that it's absorbed both Goldcorp and Newcrest. So people do get Newmont focused, and again, rightly so, but it doesn't necessarily tell the whole tale. When you look at a lot of the mid-tiers, they actually have brought their costs down and actually have fatter margins. So you look at something like Alamos Gold, or when you look at Agnico as like the second biggest gold company now, they've got actually a lot better margins than Barrick and Newmont, and I think people are starting to wake up to that. But when you go down the roster of other small to mid-sized gold producers, they're absolutely printing money right now at these margins. So do you think that it's kind of a double-edged sword where Newmont is kind of a sucker punch today, market response, but it's overshadowing good work that a lot of other companies are doing?
Yeah, I think it is. And I think there's a lot of mining companies that are still extremely profitable at these prices. And some of the, mid tiers are still doing very well, like IAG, Wesdome. But yeah, definitely overshadowed by Barrick and Newmont, the two big guys who continue to have cost inflation challenges and just can't seem to get their results up to market expectations. I mean, clearly the market bid these up in recent months with the gold price, and they have not been able to meet expectations. And that's something that is very common, and anybody who's a veteran in the sector knows that generally these big companies do disappoint. So yeah, the juniors are being unfairly punished, again. But I think it's just more opportunity. It's more opportunity early. We're early in this move.
Well, I think he even mentioned, I think in our last call or maybe the call before it, that Newmont and Barrick and everybody that's the majors have to actually show people the money, show me the money. And while they are showing people the money, they're missing expectations. So that is a negative impact. But when you look at the whole sector of the producers, both gold and silver right now in Q3, I expect to still see some solid revenues generated. Do you think it helps the M&A cycle that these guys are still massing up lots of money on the balance sheet, or a lot of them have paid off a lot of their debt? Can it lead to more M&A? Should it lead to more M&A?
Yeah, I think it should. I mean, in the case of Newmont, they're divesting a lot of non-core assets. They're raising a lot of cash. But you know what they've been doing with that cash? They've been paying dividends and buying back their stock. So, yeah, they're not using it to buy other companies yet. Will they in the future? Probably. But for Newmont and Barrick, they're probably going to just buy other large companies like above 10 billion market cap. They're not going to be buying a lot of juniors yet. We're still not in that stage in the cycle, and most juniors don't have projects of the caliber, the scale, the size, the grade, the tier one status, that would interest Barrick and Newmont. But it's interesting, like we saw last year with Barrick, got into Idaho on that new copper porphyry belt in a big way. And that was something unusual. That was something that we wouldn't normally think Barrick would do. They've spent in total, I think, $40 million or so on that porphyry copper belt, both in terms of buying a stake in big.v, but also in doing a lot of staking. And that just shows that they see they need to make their own future. They have to invest in the future into making new, discoveries and finding new mines around the world, and that they can't just count on it to come to them, like either through their asset portfolio or through acquisitions of other companies. But yeah, I think we are in the M&A cycle. We're well into it now, but we're not at the point where the juniors get bought up a lot yet. I think that's probably going to be more of a 2025 story.
Well, I guess when I was asking the question, I was thinking of not Newmont and Barrick because they are kind of divesting larger projects or just acquiring massive companies. I was thinking of those cashed up mid-tiers or the smaller seniors, because we have seen Goldfields go down and make an acquisition of a Cisco Mining. We have seen, well, you mentioned the caliber of companies, and maybe think of Caliber Mining. They went out and bought Marathon Gold, which was a development project in Newfoundland. So there are some of the mid-tiers and smaller majors going down, making some deals. But the juniors, it seems like the thought process for the majors is to take strategic positions of 9.9% or maybe up to 19.9%. Is that the model, that the biggest developers get bought out by the mid-tier producers, not the majors, and that the juniors get strategic stakeholds? And if they don't get one of those strategic stakeholds, they're kind of getting left in the dust. There's kind of a story of the haves and the have-nots.
That's absolutely right. Yeah, and that's what people need to understand. Like, it's really rare for a really large company to invest in a junior, and usually it's at the JV level where they're just taking, like an interest, a stake in the property, not in the company. And yeah, and also it's a scale thing. So are the projects large enough to attract even, like a mid-tier? Are they large enough? Do they move the, needle? I notice a bunch of companies, I don't know a bunch, but there's a handful of companies right now who are tying up mid-scale, deposits. So they're looking in that 2 million ounce range in terms of gold projects, and they're acquiring them and rolling them into the same company. So maybe one company has 2 or 3 million ounce gold projects in the same entity. Now that's at a scale that's not large enough for the majors, but it could be interesting to a mid-tier if it gets permitted and if the economics are compelling enough. They could get acquired by a larger company. But I see some juniors in the 100 to 300 million market cap range doing this strategy of rolling up the unloved stuff held by juniors that's in that 2 million ounce to 3 million ounce range.
Well, I'm curious what you think of that strategy, because we've seen that with Black Copper and Gold merging with Treasury Metals to form Next Gold. That then just merged with Signal Gold. And so now they actually have two different 3 million ounce deposits between the Goliath Goldland and then between Gold Barrel. So now they've got two projects, and I actually met with them at that conference we were just at, and their idea was, hey, they're both pretty far advanced on the permitting. Whichever one gets permitted first, that's the one we build, and then the other, we use the money from that to build the second one. We saw it with Nighthawk combining with Moneta. We've seen a couple roll-ups where multiple juniors are kind of mashing their stuff together to form bigger companies, like Millennial Precious Metals merged with Integra to make a bigger Integra, that then bought Florida Canyon to make a producing Integra. You've seen some kind of mashup to become larger entities. Is that a good approach, just to get maybe a larger shareholder base or more eyeballs because of scale or size? Or is that a strategy that's just still making them bigger companies but still not big enough for majors?
Bigger companies, but still not big enough for majors. I mean, it's basically these companies are going to have to put one or two of these projects, into operation, and they're going to have to show that they work. So just because you tie up a bunch of assets and put them under the same entity, you can say, well, look, we have 9 million ounces total, doesn't mean that it's worth a lot more. So when you have 3 different assets or 4 different assets and they all total 9 million ounces, it's not the same as having one deposit, one project with 9 million ounces that could be a tier 1 project for a major. So basically, these companies are going to have to become operators, most likely. They're going to have to prove that the economics of these ore bodies work, right? But I think the strategy is, if we can roll them all up into one company, we can lower our cost of capital, because for a junior to advance a 2 million ounce deposit by itself is a prohibitive cost. And that's why their valuations are so low on a per ounce basis. But maybe instead of having a 20% cost of capital, maybe if we put them under one entity with the right backing, maybe it's a 10% or 12% cost of capital, which isn't too punishing. It's still not cheap, but it doesn't kill the projects, right? And so I think that's what some of these companies are doing.
Well, let's shift our focus over to the red metal copper. I know you're a big fan of copper, as am I. I think there's undeniable fundamentals driving the long-term side of copper, but that doesn't mean that the short-term fundamentals will align. I think there's a lot of cognitive dissonance here between the longer-term fundamentals of supply-demand and the short-term gyrations that we see, especially when you drill down into the junior copper stocks that are exploring and developing the next projects of merit. How are you looking at the copper sector setup, I guess, the shorter term outlook and then the longer term outlook?
Well, I mean, it's still so early. I mean, copper has been dropping in October. It's basically just gyrating around 430 a pound. It's barely moving. And a lot of the copper juniors are kind of flat on their ass here. There was a run back in April, May. There was some good weeks, but since then, the air has kind of come out of these stocks. So I think it's a tremendous opportunity. And, quite frankly, I would rather buy a copper junior here than a gold junior. Although I'm bullish on both metals, I think that there's even more upside, in the copper space. And we saw kind of overstimulation for me here this week. A new discovery in Michigan by Talon Metals was just announced here this morning. Copper and nickel in Michigan. So the first hole into a new target, it hits 100 meters of 1.6% copper equivalent, the Boulder Dash target. So that's pretty incredible to basically, acquire a new project last year, do some field work, do some magnetics, and then they drill an anomaly that lines up with some boulders in outcrop, and boom, they hit. So there's a lot of news, a lot of new discoveries happening. There's a lot of energy in the junior mining sector here the last few weeks, and it's a wonderful change of pace, and it makes me jump out of bed every morning. So I'm happy to see that. But I think there are a lot of opportunities in copper. Even Big.V, which was that fantastic story in Q4 of 2023 that went from 25 cents to $1.60. On the back of a new porphyry discovery in Idaho, and then an investment by Barrick. Well, it's a little bit down on its luck here in recent months. They put out the first set of assays a couple of weeks ago. they had one really good hole. They had some holes that weren't so fantastic, but that's the process of, new discovery. You're not going to hit on every hole. And, when it went to 160, it was clearly a little overdone. There was a little too much optimism there at a 400 million market cap based upon one drill hole. And now it's you could make the argument that it's on the other side of that pendulum here, where it's sort of out of favor. The market cap's dropped quite substantially. I think it's about 150 million now, which is a little more reasonable. And they've had more proof that this thing is potentially actually quite extensive, right? So, we'll have to see. There's a lot more holes pending assays, but I like this opportunity here across a lot of these copper explorers.
Well, and just to follow up on the copper explorers, I mean, it's even more so the case than it even is with gold or silver companies that it's so expensive to drill out copper projects that you almost have to be partnered with the major. I know that I can think of probably a dozen or 24 companies that have strategics as the majors, the Rio Tintos, the BHPs, the Glencores, even some large gold companies, the Barricks, like in the case of Hercules, you just mentioned Barrick coming in to take an open market stake, which is very unusual for Barrick. But just the nature of the beast is it's expensive to drill copper porphyries. You got to go down deep. The drill holes cost a lot. Is it really a story of filtering through, let's just say, the 50 to 100 juniors in the copper space, looking for the ones that are partnered with the big boys?
I mean, I think that's one strategy that people might take, but I think you really need to look at the jurisdiction first. So is it a tier one, jurisdiction? Is it in Arizona, for example, right? Like that's a good checkbox. And then number two, are the targets big enough, right? Is the property package large enough? If it's, like an IP signature, is the IP target big enough, right? Or maybe it's got, it's been drilled before. So you can actually look at the results and you can see, oh, okay, like these two hits are, a mile apart and they hit high grade in both of them. They just haven't tied it all in. And maybe for some reason, the properties were fractured. There were 3 or 4 owners, and maybe the company put it all into one property package. And now that's the new opportunity, because there's big gaps in the historical work that was done. And maybe this company can tie it all in and show that there's big ore body there, right? So you have to look at it company by company. And I know people love cookie cutter rules and they love like principles and rules to go on, but that just doesn't work very well in the junior mining sector. You really have to analyze the details of each one. And that's why most people just buy the exchange traded funds or buy the majors, but then they'll miss out on the potentially 10x, sort of upside, but they also won't have to wait for assays for 4 or 5 months and worry about why the stock dropped 20% on no news, which happens in the junior mining sector all the time, right? So the knife cuts both ways. There's pros and cons to it. But in the junior mining sector, you really need to look at details. And I think management, quality of management, track record of management, share structure, and jurisdiction of projects is like those are paramount, right? So if you can check those boxes when you first take a look at something, then maybe, you dig deeper.
Oh, for sure. It's a nuanced sector, and there's no shortage of risk and no shortage of things you have to really dig through. But I guess let me ask you it a different way. If there are copper companies that have partnered with majors, let's say they're partnered with Rio Tinto or BHP, or they're partnered with South 32 or the Lundin Mining Group, which is very big in the copper space, don't you think that in that sense, that major or that key strategic shareholder has already vetted the company for you in a sense?
Yeah, they have. But also they're not on your time frame. They don't have your, risk tolerance. It's not exactly the same. And they might have a lower cost basis, So, but I've also, I'll give a little secret to the audience, right? So I've heard about some of these billionaire investors and some of their DD. And some of these people, these groups, will write a $5 or $10 million check with 24 hours of work done. Like they will move fast and they won't know every detail. Some groups do more DD than others, but for some of them, $5 or $10 million is not enough to make them really, lose sleep at night. And they would just want to take a 9% stake and move fast. They see a result, they see the company drilled some high grade at a new target, and they just want to get in, right? And very often they'll move fast without digging too deep, right? So you have to be conscious of that too.
I think it's a great point, man. I don't think anybody else on any podcast has ever made that point, that sometimes these guys throwing down $5-10 million is pocket change, not pocket change, but it's, like you say, not something they're going to lose sleep over. So they're taking a flyer on some of these just like we are as investors sometimes. So you really need to do your own due diligence and dig into these. Well, one other sector that's happening in tandem with the copper, the gold, and the silver was also uranium, Robert. We had 3 or 4 different tech companies, Google, Amazon, Microsoft, DataBank, all coming out and saying, we're going to be building small modular reactors or bringing past producing reactors back online. We've seen a little bit of a bounce in what's been a rough couple months before that in the uranium stocks, but it's also a larger messaging. I was amazed that some friends I have say, hey, what do you think of nuclear energy and uranium that don't even follow the mining sector? And we've had some generalists on our show that can't even spell mining stocks, but are like, hey, I'm starting to look at uranium stocks. What do you think about big tech shining a flashlight on the importance of the supply chain?
I think it's fantastic. I mean, Cameco, NextGen, like these stocks have had such incredible moves, but this is a bull market that is probably going to be like a decade long, right? So if we say it started in 2020 or 2021, we're only a few years into it. And wow, we got Amazon, Google, Microsoft, all getting into, the nuclear energy space. Wow. I mean, I didn't see this coming, right? It wasn't on my bingo card for 2024, but AI and the need for power and need to power these data centers, it makes it absolutely necessary. We need more of these power plants, right? So just Cameco, like all of these companies have just made Cameco that much more profitable and basically increased their valuation, multiple quite substantially here, right? And I think there's probably more to go. As crazy as that is for me to say at whatever $55 a share in CCJ, I mean, I think that these are, it's one of those stocks that I would just set it and forget it and wake up, when it hits 75 or 80. And then maybe, you take, some off the table, but it's an incredible bull market. And all you need to know is when Amazon, Microsoft, and Google and Apple are just signing these deals right now for the first time ever, well, it's probably not late in the game. It's probably the game is just starting.
Yeah, that's the big boys in the tech sector doing it. That means all the mid-tiers and smaller companies in the tech space are probably going to be looking for similar alliances. And hopefully it also shines a light on the fact of, hey, after you've generated all that power with small modular reactors, how are you going to get it there without copper? So there's still a kicker in there that people will start doing the math and realizing, wow, we're going to need a lot more copper wiring. Even the chips for AI are going to need a lot more copper. So hopefully the uranium copper energy metal side of the things gets things even more exciting for the critical minerals component of the resource sector. And I guess just wrapping up, I want to just kind of circle back to what we started with. We were both at a conference in Fort Lauderdale, the Global Commodities Expo. There was a kind of a smaller boutique conference, but I think really quality companies there, really quality investors there. Always just like to get people's takeaway after being at a conference for a couple of days. What did you learn? What insights or sentiment reading? Anything else you take away from the conference?
Yeah, it was a nice conference. I really enjoyed it. It was at an unusual location, the Four Seasons Hotel in Fort Lauderdale Beach. I hope they come back again, next year. I really think my takeaway is that it's still early. I mean, I think that's my big takeaway. I think I had 8 meetings. They were all good meetings. I did learn a few things from some of the companies, but I think my big takeaway is just from a sentiment standpoint that it was not super well attended. And the fact that you have all these great CEOs and investors in one place in a beautiful location on the beach, and you're going to have a gold panel that has a lot of empty seats in it, it's still really early. But I think it's a great conference, and I hope they do it again in 2025, and we should have a much better turnout in 2025.
Yeah, I kind of had some similar takeaways in the sense that sometimes people are more excited to be out in the sunshine and the beach, and hey, who can blame them? But I think that some of those panels were so good that it's still early in the cycle, because I think by next year there'll be standing room only where people are packed into an event like that to learn what's next. But Robert, always a fountain of knowledge on all these different areas of the resource space, as well as the macro take on things. And if people want to follow along with Robert's work, definitely click on the links below this interview. I'll put a couple that take you over to his Goldfinger Capital Substack and YouTube page, as well as his comments on X Twitter, because he's out there every day, folks, putting out interesting news. I sure read everything you put out, man. And looking forward to our next conversation, maybe in a month or so.
Thanks, Chad. I appreciate it. Thank you.